How to invest for beginners, a detailed explanation. 1. What is investment? Investing means using a portion of your money capital to purchase assets or financial instruments with the goal of increasing that capital over time. Assets can be stocks, bonds, real estate, mutual funds, gold, or projects. 2. Why is investing important? To preserve the value of your money over time against inflation price increases. To increase your wealth and generate additional income. To achieve financial goals such as buying a home, education, or a comfortable retirement. 3. Step 1. Determine your financial goals. Before you invest, you need to know your goals. Do you want to save for a short period, such as a year or two? Or do you want to invest for the long term, 10 years or more? Defining goals helps you choose the right type of investment. 4. Step 2. Know your risk tolerance. Each investment has a certain degree of risk. Stocks are high risk but may offer high returns. Bonds are less risky but offer lower returns. You need to know how much risk you can tolerate to choose the right investments. 5. Step 3. Build a diversified investment portfolio. Diversification means spreading your money across different types of investments to reduce risk. For example, you could invest in stocks, bonds, and real estate investment trusts. This reduces the chance of losing all your money on a single investment. 6. Step 4. Open an investment account. You need to open an account with a brokerage firm. Brokerage firms allow you to buy and sell stocks, funds, and bonds. In the U.S., well-known companies include Fidelity, Charles Schwab, and E-Trade. 7. Step 5. Choosing the right investments. Beginners should start with exchange-traded funds, ETFs, or mutual funds because they provide automatic diversification. After gaining experience, you can start buying individual stocks. 8. Step 6. Continuous learning and monitoring. The financial market is constantly changing, so you must follow market news and learn continuously. Take advantage of free educational resources such as YouTube videos, blogs, and courses. 9. Step 7. Regular investing, dollar cost averaging. Instead of investing a large sum at once, invest small amounts periodically, for example, monthly. This reduces the impact of market fluctuations and lowers the average purchase price. 10. Step 8. Patience and don't panic. Long-term investing requires patience. Markets may decline and close, but over the long term, they usually rebound. Don't sell your investments quickly when the market declines. Additional tips for beginners. Don't invest money you need soon. Avoid high-interest debt before investing. Consult a financial advisor if you are unsure.
We'll go into more detail on each point of how to invest for beginners, with practical examples and detailed advice. 1. What is investing? Investing is allocating money to things whose value is expected to increase over time. For example, if you buy a stock in a company like Apple for $150 and wait a year, the stock price could rise to $200, making a profit of $50 before taxes and commissions. Investing is different from saving. Saving means putting your money in a bank without risk, but with a lower return, while investing involves risk but offers a higher return over the long term. 2. Why is investing important? Inflation. This means rising prices for goods and services. If your money is just sitting in a bank with a low return, its value will decrease over time. Investing protects your money from inflation because it can increase your capital faster than the rate of inflation. Imagine if inflation is 3% annually and the investment return is 7%. This means a real net profit of 4%. 3. Determine your financial goals. Short-term goals, 1 to 3 years, buying a car, traveling, or paying off debt. For short-term investing, invest in safe assets such as bonds or high-yield savings accounts. Medium-term goals, 3 to 10 years. Paying a down payment on a house, educating your children. Long-term goals, 10 years or more. Retirement, building wealth. Greater than, for example, if your goal is to retire in 20 years, invest in high-growth assets such as stocks. 4. Risk tolerance. Risk is measured by the volatility of an investment's value. A young person may tolerate higher risks because they have time to recoup losses. A person close to retirement needs lower risk investments. A risk tolerance test is available at many brokerage firms. Questions that measure your comfort with potential losses. 5. Portfolio diversification. Practical example. If you have $10,000, 60% in stocks, 30% in bonds, 10% in cash or safe investments. This reduces losses if, for example, the market declines. Bonds may be stable or rise. 6. Open an investment account. Brokerage firms offer accounts with no or low fees. Make sure you understand the service fees and commissions. Some platforms, like Robinhood, allow you to buy stocks commission-free. 7. Selecting investments. Exchange-traded funds, ETFs. These combine many stocks into a single fund, such as a fund that includes the 500 largest U.S. companies, S&P 500 ETF. Mutual funds. These are managed by a professional manager and may have higher fees. Individual stocks. These require knowledge and research. Bonds. These are loans to companies or governments that offer fixed returns and are less risky. 8. Continuous learning. Take advantage of resources such as Investopedia, CNBC, free courses on Coursera or Udemy. Learn terms like return on investment, ROI, price to earnings ratio, P/E ratio, and dividends. 9. Regular investing, dollar cost averaging. Instead of investing $12,000 at once, invest $1,000 monthly. This mitigates the impact of sudden price increases because you buy at fluctuating prices. 10. Patience. Don't expect quick profits. Markets go through cycles of ups and downs. Many investors lose money by panicking and selling stocks when prices fall. Practical examples for beginners. Open an account with Fidelity or Vanguard. Invest $500 monthly in an S&P 500 ETF. Monitor performance only every 6 months. And don't sell due to short-term fluctuations. Common mistakes beginners should avoid. Investing based on friends' advice or unreliable news. Trying to time the market. Buy and sell based on short-term expectations. Putting all your money into a single stock. Ignoring costs and fees that may reduce returns. We continue to delve deeper into the topic of investing for beginners, with a detailed explanation of practical tools, strategies, and techniques that will help you enter the world of investing with confidence. 11. Types of investments in detail. Stocks represent ownership in a company. If the company makes profits, the share price rises, and it may pay periodic dividends. The risk is relatively high, but the long-term return is good. Bonds. Debt issued by governments or companies. They provide a fixed return, interest, over a specified period, then repay the capital. They are less risky than stocks. Mutual funds and ETFs. Pool the money of many investors to purchase a diversified portfolio of stocks and bonds. They reduce risk due to diversification and are managed by professionals. Real estate. Purchasing real estate for the purpose of renting it out or selling it at a higher price. They require more capital, but they provide consistent income and a relatively stable value. Gold and precious metals, used as a hedge against inflation and economic crises. The return is limited, but they reduce the risk in the portfolio. 12. How to read investment statements. Stock price. The current market value of a stock. Price to earnings ratio, P/E ratio, reflects the stock's valuation relative to the company's earnings. A high value may indicate significant growth prospects. Return on investment, ROI, the percentage of profit earned from an investment. Dividends, a portion of a company's profits distributed to shareholders. 13. Investment strategies for beginners. Long-term investing, buy and hold, buying assets and holding them for years, benefiting from market growth over time. Regular investing, dollar cost averaging, purchasing assets in fixed amounts periodically, regardless of prices, to reduce the impact of market volatility. Rebalancing, adjusting the asset ratios in your portfolio periodically, e.g., annually, to return to target ratios, such as decreasing the percentage of stocks and increasing bonds if stocks rise too much. 14. How to choose a broker. Low fees and commissions. Some companies offer commission-free trading on stocks and funds. Ease of use. Easy to understand and track your investments. Customer service. Fast and efficient support. Educational tools. Provides lessons, analysis, and market news. 15. Common mistakes. Beginners should avoid rushing for quick profits. Trying to buy stocks that suddenly rise without research. Lack of diversification. Putting all your money into one stock or sector. Lack of a plan. Randomly investing without clear goals. Impatiently selling investments after short declines. 16. Useful tools for beginners. Portfolio trackers. Apps like Personal Capital or Mint help you track your portfolio's performance. Stock analysis websites, such as Yahoo Finance, Morningstar, and Seeking Alpha. Free courses. Platforms like Coursera and Khan Academy offer free courses on investing. 17. The importance of psychology in investing. Control emotions. Don't let fear or greed control your decisions. Rational thinking. Making decisions based on data and analysis, not rumors or temporary negative news. We dive deeper into the details of investing for beginners, with advanced strategies, psychological advice, and tools to help you elevate your investment with confidence and professionalism. 18. Advanced investment strategies for advanced beginners. Value investing. Looking for stocks of companies whose current price is lower than their intrinsic value, low price relative to their earnings or assets. Example: a company whose share price is lower than its book value and has strong financial fundamentals. Dividend investing. Focusing on buying stocks that pay periodic dividends. This provides regular income alongside capital appreciation. Sector investing. Distributing funds across different sectors, technology, healthcare, energy, etc., based on sector growth expectations. Thematic ETFs, such as funds focused on clean energy, artificial intelligence, or blockchain. 19. How to deal with market volatility. Don't be afraid of volatility. Market volatility is completely normal. Part of investing is dealing with these fluctuations calmly. Remember your long-term goal. Focus on your primary goal and don't sell out of temporary fear. Use hedging strategies, such as investing a portion of your portfolio in gold or bonds to reduce risk. 20. Robo-advisors. Digital platforms that use algorithms to manage your portfolio based on your goals and risk tolerance. They provide you with a balanced investment plan without requiring in-depth knowledge. Examples: Betterment, Wealthfront. 21. Taxes and their impact on your investments. Understanding taxes is important to understand how they affect your earnings. There are tax-exempt or tax-deferred investment accounts, such as 401ks and IRAs in the US. Tip: consult a tax professional or financial advisor for proper tax planning. 22. How to get started with practical steps. A simple example budget. Decide how much you can invest monthly without affecting your basic expenses. Open an investment account. Choose an easy and reliable brokerage platform. Choose an initial investment. Public ETFs like the S&P 500. Regular investing. Invest the same amount each month. Monitoring performance. Track performance but don't be influenced by daily fluctuations. Continuous learning. Follow market news and read about new strategies. 23. Important psychological advice for investors: don't expect to get rich overnight. Investing is a long journey. Accept small losses as part of the process. Avoid impulsive or emotionally driven decisions. Surround yourself with reliable sources of information and avoid rumors. 24. Monitor and evaluate performance. Review your portfolio every 6 months. Compare the performance of your investments to indices, such as the S&P 500. Adjust the ratios if necessary based on your current goals. Would you like me to prepare a PDF or a practical step-by-step investment plan for you? Or would you like advice on how to choose stocks or funds?